All right, let's jump right in. Welcome to This Explainer. Today we're unpacking a highly frustrating but completely predictable pattern of modern economics: privatized gains and socialized losses. If you've ever watched the economy tank and wondered why the folks who caused the mess seem to be doing perfectly fine, believe me, you are not alone. Let's decode exactly how this all works. Okay, let's dive into this. Privatized gains, socialized losses. Now, sure, it sounds like some dusty theory from an economics textbook. But for most of us, this phrase perfectly captures that painfully familiar feeling of an economic downturn. Just look at how this actually plays out in the real world. When the markets are red hot and booming, the profits shoot straight upward. They go to the banks, the hedge funds, the venture capitalists, corporate executives, basically the folks right at the source of the money printer. But when those speculative bubbles inevitably burst, wow, the damage flows rapidly downward. It crashes straight onto everyday people. Workers lose their jobs, families lose their homes, pension funds get totally wiped out, and taxpayers are the ones forced to foot the bill for the bailouts. Which brings us to a really massive, critical question. Why do the institutions that actually help create the crisis almost always seem to survive it? And not just survive, but sometimes come out even bigger than they were before. Well, economists argue that this unfairness, this extreme asymmetry, isn't just an occasional glitch in the matrix. It is actually a built-in structural feature of modern financial capitalism. To really understand why this keeps happening, we need a sort of economic decoder ring. Throughout modern history, speculative bubbles just don't pop up randomly out of nowhere. They follow a highly predictable repeating script. We call it the five-stage bubble cycle. Once you see these 5 steps, innovation, cheap credit, detachment, leverage, and the trigger event, you're going to recognize how this exact same movie keeps getting greenlit over and over again. Let's break it down, starting at the very beginning. Phase 1 is always rooted in something incredibly real. Like we just said, bubbles rarely start out of thin air. They usually begin with a genuine, massive innovation or a big shift in regulations that creates totally justifiable excitement. Think about the railroads back in the 1870s, or the early internet, or right now with AI. These provide real transformative value. But here's the catch. That legitimate innovation almost always becomes the seed that sprouts deeply irrational speculation. Once that excitement hits a fever pitch, we enter phase 2. Cheap credit completely floods the zone. Banks drop their lending standards, interest rates are kept super low, and all this speculative cash just pours straight gasoline on the fire. It creates this incredibly dangerous illusion that prices can literally only go in one direction, up. The whole psychology of the market violently shifts. People completely stop asking the rational question, hey, what is this actually worth? And they start screaming, how quickly can I get in before I miss out? It is pure FOMO, and it powers nearly every bubble in history. By phase 3, things get a little crazy. Asset prices completely detach from reality. Valuations lose absolutely any connection to actual profits or underlying fundamentals. And instead of looking at the math, people just start buying into narratives. You'll start hearing phrases exactly like this one. This time is different. Or the old valuation models just don't apply anymore. Listen, history tells us these are blaring red warning signs. Because whenever people claim the old rules of economics are dead, well, gravity eventually returns. Now, what's really interesting about this slide is the hidden complexity introduced here in phase 4, leverage. This right here is the trapdoor that turns an ordinary run-of-the-mill bubble into a catastrophic systemic financial crisis. Leverage simply means using borrowed money to amplify your returns. When prices are climbing, leverage makes your profits absolutely explode. But when prices fall, leverage ensures the whole system implodes much, much faster. Whether it's margin trading back in 1929 or complex mortgage derivatives in 2008, this creates so much opacity that regulators and sometimes even the executives themselves have no idea how much massive risk they're actually sitting on. And inevitably, that brings us to phase 5, the trigger event. Every single bubble eventually slams face first into reality. It could be a sudden railroad bankruptcy, a spike in interest rates, corporate earnings misses, or some huge fraud being exposed. But whatever the trigger is, it instantly exposes the fragility of the whole system. Once confidence shatters, panic spreads like wildfire. Suddenly, everyone rushes for the exits, all at the exact same time. But the brutal, terrifying reality? That exit door just isn't big enough for everyone. And as you can see on this timeline, this is definitely not some weird new phenomenon. This exact 5-stage model has been absolutely wrecking the finances of ordinary Americans for over 150 years. We're talking a reckless financing and the Panic of 1873. Massive margin debt fueling the 1929 stock market crash, deregulation sparking the 80s savings and loan crisis, the dot-com bust in 2000, and of course the 2008 financial crisis where millions of normal people lost their homes while Wall Street got a lifeline. The branding changes every decade, sure, but the underlying mechanics are eerily identical. So let's impartially apply our decoder ring to what we're actually seeing in the markets today. Take a look at Bitcoin and artificial intelligence. Now, let's be super clear. This absolutely does not mean AI or crypto are inherently worthless. Not at all. The internet survived the dot-com crash to become a foundational technology, and AI very well might do the exact same thing. But look closely at the speculative behavior here. Bitcoin is driven by this powerful mythology of digital gold and decentralized freedom, which sounds an awful lot like the narratives that drove past bubbles. Meanwhile, AI valuations are wildly concentrated in just a handful of massive tech giants based on projected future dominance. The underlying value is very real, but the speculative frenzy around them perfectly mirrors those historical warning signs we just talked about. Now, you might be sitting there thinking, well, I don't buy crypto, and I'm definitely not betting my savings on AI tech stocks, so I'm totally fine. But wait, look at the hidden public exposure here. If these massively concentrated valuations compress sharply, your pension funds, your index funds, your 401ks, and basically your entire retirement system are heavily exposed. Millions of everyday people who never even consciously chose to play this speculative casino game could still absorb absolutely devastating losses. Which brings us to perhaps the most infuriating, heavily debated part of this entire cycle: moral hazard. When the inevitable collapse happens, why do we keep seeing massive government bailouts? It's because these financial institutions intertwine themselves so deeply into your ordinary life, into your checking account, your employer's payroll, that letting them fail would literally cause mass suffering. They make themselves too big to fail. Because these firms know the government will ultimately rush in and rescue them to prevent a full-blown depression, they take wildly larger risks. The upside is completely private, but the public effectively becomes their mandatory, taxpayer-funded insurance policy. But check out this truly shocking constraint we have to face today: $36 trillion. That is the current U.S. national debt, and the interest payments alone on that are now surging past $1 trillion every single year. Back in 2008, the government had the financial flexibility to just flood the markets with liquidity, slash rates to zero, and throw out a massive bailout net. Today, trying to repeat that exact same 2008 bailout playbook is going to be incredibly difficult, if not downright impossible, without triggering some totally catastrophic secondary effects. Because think about it, if the government simply tries to print and borrow its way out of the next massive collapse, what's the immediate consequence? Boom, inflation. And inflation acts exactly like a stealth tax. The source material argues that repeating those previous bailout strategies just means everyday people feel the pain first and worst: higher rent, pricier groceries, surging utility bills, and crazy transportation costs. Meanwhile, those ultra-wealthy asset holders who cause the mess, they often stay totally insulated and sometimes even see their net worth rise, right along with inflation. And this brilliantly illustrates exactly how this unfairness gets permanently baked into the system. It all comes down to the structural roots shown here: regulatory capture. You have these crazy revolving door relationships where government regulators literally leave to take high-paying jobs at the exact banks they were just policing. Add in weak enforcement, a deep dependence on campaign finance, and massive lobbying power. The people writing the rules have become incredibly dependent on the very industries they are supposed to be keeping in check. So the absolutely crucial takeaway is this: the people gambling wildly in the speculative markets almost never experience proportional consequences for their actions. Instead, the system is perfectly tilted so that workers, retirees, renters, and taxpayers take the fall. And as long as these structural realities stay the same, the cycle is simply going to wait for the next exciting story, rebrand itself, and repeat. As we wrap up today, I want to leave you with a massive provocative question. When the next bubble bursts, why does the ugly bill always go to the ordinary people who never even played the game? It's really worth thinking about. It just might be the most expensive recurring subscription in modern economic history. Thanks so much for joining me for this explainer. Keep learning, keep questioning, and I'll see you next time.